This week on Wealth Track, the influential economist whose projections have been right on target. Financial thought leader David Rosenberg shows how the 3Ds of deleveraging, deflation, and demographics are hurting economies and markets, and where investors can go for positive returns. Next on Consuelo Mack, Wealth Track. Hello, I'm Consuelo Mack. I want to tell you about a new opportunity to watch Consuelo Mack Wealth Track before the program appears on public television. As a subscriber, you can see programs 48 hours in advance of the general public and also find timely interviews and commentaries exclusive to Wealth Track Premium subscribers. If you're interested, just go to wealthtrack.com for more information. Thank you. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. This week we are sitting down for an in-depth interview with one of the handful of prognosticators who has gotten it right going into and through the rolling global financial crisis we are experiencing to this day. He is financial thought leader David Rosenberg, chief economist and strategist at Toronto-based wealth management firm Gluskin Sheff. Dave returned to his native Canada in 2009 after spending many years as chief North American economist at Merrill Lynch, where Institutional Investor magazine placed him on their coveted All-American All-Star team from 2005 to 2008. Rosenberg took on the bullish Wall Street herd as early as 2004 when he started warning about the developing housing and credit bubble, which, as he predicted throughout, would wreak havoc on the financial system and many world economies. Well, he hit the nail on the head again last year, forecasting the global economy would slow and that Treasury bond yields would fall. Another home run. In his influential and widely read daily Breakfast with Dave reports, he ranges across the globe, covering everything from Europe and how, quote, it is rather incredible that this rolling crisis is now going on 2.5 years and policymakers have yet to find a viable solution, to emerging markets and, quote, why the once mighty BRIC currencies are depreciating of late at their fastest pace since the 1998 Asian crisis, to the financial markets and how the pattern of the past 3 years is unmistakable, as each spring the equity market corrected as stimulus measures wore off, to only then prompt more incursions by the fall. Well, what other patterns are unmistakable to Dave Rosenberg, and why did he write in a recent report that the future is brighter than you think? I asked him all of the above and more, starting with what he thinks are the most important patterns for the economy and markets.
The primary trend is still one of deleveraging. It hasn't really changed much from the last time that the two of us spoke. It's just that it's become much more global in nature. So it started off in the US 4 or 5 years ago in the American mortgage market, the housing market, consumer loans in general. But now we're seeing how it's morphed into the survival of the welfare state and all the debt finance to prop up these peripheral countries in Europe. And even now, there's questions about whether China's going to have a hard or soft landing because of a perceived property bubble there. So we're still in this deleveraging cycle, still dealing with the impact of too much debt relative to the size of the global economy. And this is what's creating all this market angst and instability that we're still living with. Notwithstanding the fact that the economy, U.S. economy, is 3 years into recovery, we're still stuck into a very slow growth mode, but recurring financial market instability at the same time.
So is there any way of knowing whether the second half is going to be worse, better, or the same as the first half? Because I'm thinking of my audience out there and myself included and saying, I don't want to live through another 3 or 4 years like this. But so what's it going to look like? I'm
going to sound like a classic economist here and say it's going to be somewhere in between. And this is what I mean. Are we going to get another gut-wrenching 7% decline in GDP and lose another 8 million jobs? I don't think we're going to go through anything close to what we endured in 08 and 09.
And two back-to-back kind of 50% declines in the stock market.
It's not going to be that bad. But then again, you have to take a look at the contours of the recovery. I actually think the recovery tells you a lot more than the actual gut-wrenching recession did. Because normally, when you do this with the economy, you do that.
You get the V.
Well,
right.
even in that 1933-36 period, you had a huge recovery, much bigger than we had this time around. And this time around, we had basically the check mark of a left-hand person. That's what we had. It was not a V-shaped recovery. It was a very meager recovery, especially when you consider everything that the government threw at this thing. And when you consider the Fed took rates to zero in December of 2008, they've tripled the size of their balance sheet, $3 trillion. We've had, 4 years of $1 trillion deficits.
The fiscal stimulus.
And more foreclosure moratoria. We've tried everything. And so we've had modest economic growth, but unacceptable. And now what's happening is the Fed is left now with all these uncreative tools. Like Ben Bernanke certainly believes that he can do more. But in Economics 101, you learn about the law of diminishing returns. And it's basically that you end up getting less and less and less incremental impact from the same policies over time. And so that was the same with QE1, QE2. With the ELTRO that we had out of Europe, we're getting just a smaller incremental impact on the economy with each individual policy proposal.
Right. So therefore, 3 years into a quote-unquote recovery, so are we on the cusp of another recession?
Cusp or precipice? I mean, I don't know if I'm quite there yet.
Right.
The economy is extremely fragile. The underlying trend in the economy is barely 2%. It's barely 2%. So when you have a trade shock that can wipe out 2 percentage points of growth, you're left with zero. Now maybe that's not a recession in the classical sense because we're not actually going in reverse, but the unemployment rate is going up in a no growth environment. And then you talk about this so-called fiscal drag, this fiscal cliff that we're going to see next year. It's because we're probably not in bad a shape as the Europeans, but here in America, we've kicked the can down the road a lot. In terms of the Bush tax cuts getting extended, in terms of payroll tax relief, extended unemployment insurance benefits, all these provisions expire December 31st. So just by the government taking back the parking permit from everybody, we have a drag out of the economy next year from fiscal restraint, 4 percentage points of GDP, 4 percentage points.
Which we don't have. So listening to you, Dave, quite honestly, I just, I do want to kind of bury my head in the sand, and I'm thinking to myself, that I want to be in incredibly safe assets, that this is no time to put risk on, and yet, one of the things that you follow as well is investor sentiment, and the fact that there is a growing despair out there, that people are very frightened and worried, and as we know traditionally, that's in fact the time when it's actually best to buy risk.
I mean, there's always opportunities. So just in a fat tail world, you got to be very cognizant of the risks. So it's as much not just focusing on the gross returns, but we have to, and this is what we're doing every day at my shop at Gluskin Sheff, is we are assessing the risk, identifying it, managing it, and pricing it. And frankly, it's not about being risk averse. People think that somehow. When you talk about risk all the time, you're risk averse. It's always important to make sure, as an investor, that you're getting paid to take on the risk.
Right.
That
So
you're not
price is really important.
Right. Like for example, I would say the high yield bond market right now is actually, I would argue, priced for a bad economic outcome. You want to buy the assets that you think have already discounted. What's embedded? What's the story in this particular asset class? What's it telling you? So I'm taking a look at the high yield market right now. I think it's actually very attractive. We have a core portfolio of high yield bonds. And the reason I say that is because ultimately when you're buying corporate bonds, you are staking a claim in the corporate balance sheet.
Right.
And the one thing that has not changed, despite the fact that we've got all this angst overseas, the fact that the US economy is hit stall speed, corporate default rates are barely more than 2%. You've got corporate balance sheets in great shape, whether you look at debt equity ratios or interest coverage ratios, the fact that treasurers at companies in both Canada and the US have locked in their maturity schedules. 80% of corporate debt is locked in. And in some sense, the corporate sector is in better financial shape than the government sector is. So I like corporate bonds.
One of the things that you've told clients is that reliance on deriving a stable income stream while preserving capital is paramount right now. So in these uncertain times, stability of income stream is one of your major investment focuses.
Right, and it comes down to what my overall theme is called the macro and market outlook in 3D. So I've been talking about the 3Ds. What are the 3Ds? Well, they're deflation, there's demographics, and there's deleveraging. And we talked about the deleveraging. There's also this demographic overlay because the boomers are 55 going on 56. That's the median age. The first boomers are in their mid-60s, and so they control the wealth. Well, they're in a different part of their investment life cycle right now, and so accumulating cash flows as opposed to relying on strictly capital appreciation for the boomer class, the life cycle as far as investments are concerned, that's altered. And we're seeing it in our own business in terms of what our clients are telling us, how they like their money managed. So you got the demographics, talk about the deleveraging, but the deflation. And so people will say to me, well, I thought in a deflation, cash is king in a deflation. And the answer is, well, historically that's true. I mean, that's the ultimate capital preservation. Cash is king in a deflationary environment, except when interest rates are zero. And so then it's not cash is king, cash flow is king. Mm-hmm. So it's imperative. It's imperative that it's not just about preservation of capital, which of course in the fat tail world, which is the deleveraging world, capital preservation is key. But you have to overlay that with preservation of cash flows. That's why MLPs have been so popular.
Right.
That's why
Master
muni
limited
funds.
Partnerships.
That's right. And that's why REITs and that's why dividend growth, dividend yield have been so popular. And now people come back and say to me, but these things look so expensive. Well, yeah, they look expensive because that's what's in demand. And it doesn't mean because it's expensive you don't want to buy it. The perfume I bought is expensive. Yeah, but is it good? Yes. Well, okay, so it's expensive. That's why it's expensive, because it's a good thing to buy. These are good strategies right now, and that's why their prices have been bid up as much as they have.
As far as this pattern that we've seen for the last 3 years in the stock market, where it rallies until the spring and then it basically sells off, that has been very disheartening for investors. Are we locked into that for the foreseeable future?
I think what we have is this battle going on. We've got this battle. We got the secular forces of deflation coming from all this deleveraging, and the deleveraging, of course, takes demand out of the global economy. You get the deflation, and then you got these governments fighting it hard. So the secular forces of deflation in the marketplace, and then the tug of war as governments come in and reflate, whether it's China or whether it's the US government or whether it's the ECB. And so what this does is it creates tremendous volatility. Volatility. But once again, the question is, for an investor, what do I do with this volatility? How can I sleep at night? And that's why, in conjunction with, say, income equity over here and corporate bonds over there, there should be a slice of the portfolio in hedge funds that really hedge, long-short strategies that can actually be nimble.
There really are hedge funds that really hedge?
Well, hedge funds, they've been around for 50 years. They got a bad name in the last cycle because they weren't hedge funds.
Yes.
They were leveraged long-only funds. But there are firms out there that are either hedge funds. Gluskin Sheff is not a hedge fund, but 20% of our business is managing these long-short strategies. And it's actually a very effective way to be nimble in the marketplace when you get these dislocations. It's really just taking sectors and companies that you think are bad businesses, are going to cut their dividends, and you put a short position on them, and you couple that with a long position of the companies that you think are going to grow their dividends over time. So
let's talk about earnings, because I know that you've said that the E in the price earnings ratio, the earnings they are problematical. So what is your outlook for corporate earnings? And again, what does that mean for the stock market?
Well, corporate earnings right now have hit an inflection point. And it's not just that they're slowing, they're actually starting to contract. Earnings are actually, after a 3-year period of steady increases off those lows in 2009, corporate profits are actually now starting to decline outright. And
you're talking about the S&P 500
S&P 500, and even bigger picture, when we get the GDP numbers a couple of weeks ago, the GDP numbers give you corporate earnings for all of America, not just for the large cap companies. And corporate earnings are coming down. And my sense is that the earnings estimates by the analysts on Wall Street are still far too high. Earnings estimates are important. Well, I'm noticing that fewer companies are giving guidance. What's that telling you? That corporate CEOs, very similarly, they have a very clouded crystal ball right now. Fewer companies are giving guidance, and then the ones that are giving guidance, for everyone that's saying something positive about their business, 2 to 3 are saying something negative about what the outlook is. And on top of that, the estimates are starting to come down. I don't think they've come down enough. What does it mean for the stock market? I think that if we were going to go into a recession, normally the market corrects 20%. I'm not going to say that we're going into recession, but my sense is that the stock market is going to remain at best in the range that it's been in for the past several months. We have to respect the range. but we're going to be still in for a lot of volatility, which is why I was saying before that hedge funds that really hedge, totally appropriate. On top of that, you have to be nimble and as tactical as you possibly can be. But if you're going to ask me, do I think that there's more downside pressure given the risks out there, and especially the corporate earnings? The answer is yes. I think at this stage, without getting into, what's your call on where we can get to, I think the balance of risks is that the market goes down over the near term than goes up. And if it does, I think it'll be a great buying opportunity down the road.
Let me ask you just about another macro issue, which is what about Europe? And you've said you wrote recently that 2.5 years in, these rolling problems keep coming up in Europe, and there are no viable solutions.
Well, I mean, there are solutions. I don't know how viable they are. I think it's a matter of just looking at it realistically. The European Union was working just fine. The whole notion that we were going to try and avoid another world war or another European war at all costs. I don't think that we needed to have currency union to achieve that. You can't have a monetary union and not have a fiscal union and an integrated banking union. You can't have it.
So realistically, I mean, are the 17 countries going to sacrifice their sovereignty?
Hardly likely. I had breakfast recently with a CEO of a major Canadian bank, and he told me that they have a Eurozone breakup committee. And he said this is happening around the world. Any major multinational corporation or any business that is doing business in Europe has one of these Eurozone breakup committees, not unlike the pre-Y2K committees that you had in the late 1990s. And so you can bet your bottom euro that if that's what they're doing, the Eurocrats in Brussels are trying to come up with some sort of, you talk about viable, what's a viable exit strategy?
Right.
Unless the ECB steps up en masse and radically expands its balance sheet and starts buying the bonds of Italy and Spain en masse at auction. That's pretty radical. I don't know what the quick fix is. I think that the end game will ultimately be that the Eurozone breaks up.
One of your investment things that we've talked about basically has been capital preservation and income orientation as well. And one of the themes that you and I have talked about in the past is what you call SERP, which is safety and income at a reasonable price. Are you looking for SERP investments? Is that still a major strategy theme?
I would say that it is, the SERP has its thumbprints across all the portfolios we're running at Gluskin Sheff. In fact, what's interesting is that we, for years, since 2001, were running this one particular strategy that's called premium income, which is like it's a hybrid. It's got dividends, and it could have REITs, it could have preferreds, convertible bonds. It's really a portfolio aimed at distribution, a portfolio aimed at generating monthly cash flows for our clients.
And that's right, safety and income at a reasonable price, right?
And well, that's when we say, like, for example, when I talked about corporate bonds, and we're talking about safety in quotes. I mean, safety, it's relative. When talking about corporate bonds, it's because of the quality of the balance sheets are very strong. Because that's inherently, when you're buying corporate bonds, it's mostly about default risk. You want to minimize that, strong balance sheets. When I talk about in the equity side, we're talking about running portfolios that have a low beta, which means low correlations with the overall market direction.
The overall stock market direction.
The overall stock market direction. So we're talking about, so it's not just about, does this company have a consistent history of paying out dividends and, we like the business. It's also, how does it move relative to the overall market? So in a period like this where it's very tumultuous and where the market's more prone to go down than up, you want to run your portfolios with very low betas. And so that's the safety part. That's the S part of the ERP.
And the low correlation of the markets in a highly correlated market, which is what we've been in for the last several years. So what are the areas that aren't correlated, that have low betas?
Well, for example, one of the themes that we've liked has been the consumer frugality theme. So it means consignment stores. It means private label. It means do-it-yourselfers. For example, you could actually say, well, because a Home Depot, does it fall under that category as an example? I'm not going to go sell my home. I'm not going to move. I'm underwater in my mortgage, but you know what? I still want to have a fun life. So instead of buying a new home, I'll spruce up my existing home. And so home repair, do-it-yourselfer.
Can you match a name or two to the frugality theme? So, for instance, for frugality, what's a logical investment?
I'll tell you one area. I'll tell you one area where we have been long and it's worked out well has been the dollar stores, and they've been phenomenal investments. And by the way, it's not just because low-income households shop there. You'd find, and what the studies are showing is that a greater share of middle-income households are actually going to dollar stores, and that's an area where we have focused on in terms of our consumer exposure.
Let me run down a couple of the other investment themes. Non-cyclical. So give me what's the theory behind the non-cyclical emphasis, and give me an idea.
It's all about generating stable cash flows in an uncertain environment. What do you want in an uncertain environment? You want stability. What about utilities? Regulated utilities. Regulated utilities. They have regulated pricing power. What about telecom? And it might not just be the stock. You might want to buy the bonds of these companies. Once again, if you have a single A telecom company that's giving you a triple B yield, I'll be happy to take that all day long in terms of looking at the risk and reward. So telecom, utilities, consumer staples. These are the areas that will tend to outperform in the environment that I'm describing right now.
And one other category that you had is hard assets. So what are we talking about when you're emphasizing hard assets?
Resources are not a bad place to be. They've already corrected quite a bit. So resources, whether it's raw food or whether it's, I would say, energy, which has corrected quite a bit. If you're a long-term investor, these are the complements. They're not going to generate a yield for you, but they are what you want to own, things you can see, touch, and feel in a very uncertain world. And these things have cheapened up quite a bit as a hedge against the income part of the portfolio.
So one question is, one investment for a long-term diversified portfolio, what is it that you would recommend that we all own some of?
Well, I am still a big advocate of corporate bonds. As I said, I think balance sheets are in great shape. Default rates are low. There's too much default risk priced in. And so I would focus on, let's try and generate equity-like returns without taking on the equity risk. And there is a part of the capital structure that can accomplish that, and it's called corporate credit. That is still, to me, a happy medium between 0% treasury bills and going out into the riskiest part of the equity structure. So corporate bonds, to me, are a solid investment.
And Dave Rosenberg, you have a reputation of being a perma bear, which is not fair because you were also known as a perma bull in the 80s and the 90s. And in a recent report, you said the future is brighter than you think. Why, when others are despairing, are you getting enthusiastic about the future?
Well, I'm not going to say I'm getting enthusiastic about the future. What I am willing to do is put out some check marks as to what can cause me to turn more optimistic. And so I see a flicker of light. And it's a realization that politics will lead the financial markets, which will lead the economy. And what leads the politics is the grassroots level. And so what happened last month, for example, I think in Wisconsin with the recall in San Jose, San Diego, and there seems to be this growing realization at the grassroots level that we have to get our public sector balance sheets into better shape, that these underfunded liabilities have to come under control. So we're starting to see more of a groundswell of support. What I'm thinking about is how things will change politically on November the 6th. Understanding, coming from Canada, Canada went through what Europe is going through right now. Canada is going through what the US is going through back in the early 1990s. You could never have predicted that Canada 10 years later would be the poster child for fiscal integrity globally. But it took tremendous political courage.
We'll see what happens, and that's what you're going to be watching, Dave Rosenberg.
I'm more than willing to reclaim my status as a perma bull that I had in the 80s and 90s if I see those clouds part come November.
All right. Dave Rosenberg, so great to have you here from Canada, Gluskin, Sheff. It is always a pleasure to have you on Wealth Track.
Thank you.
At the conclusion of every Wealth Track, we try to leave you with one suggestion to help you build and protect your wealth over the long term. This week's reiterates one we just talked about, Dave Rosenberg's longtime income-generating strategy, which is SERP, safety and income at a reasonable price. So this week's action point is seek safety and income at a reasonable price, or SERP. Everything we know about the financial markets points to ongoing volatility and headwinds for stock price appreciation. So among the areas Rosenberg recommends where you can find reliable dividend growth and dividend yields are Canadian and U.S. preferred stock shares, which are senior to common stocks, energy infrastructure investments such as natural gas pipelines, and utilities, all SERP vehicles. And that concludes this edition of Wealth Track. I hope you can join us next week. We're going to sit down with an investment professional who combines two disciplines, investment strategy and actual fund management. BlackRock consultant Bob Dahl will join us to discuss macro trends and micro strategies. Until then, to see this program again or others and read my action points and our guests' investment recommendations, please visit our website, wealthtrack.com. Have a great weekend and make the week ahead a profitable and a productive one.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. And Tocqueville Asset Management, contrarian investors combining independent thought with in-depth research.